6-hour time frame. We have the S&P on the left, the NASDAQ in the middle, and the Dow on the right. So what would this candle be right here? This is the interactive part. Yes, it would be a TPD. Now this formed on Tuesday in the afternoon. So going from the 6-hour time frame for 6-hour TPDs, you go to one-hour time frame. So this is the time frame alignment for 6-hour TPDs. From a 6-hour TPD, your lower time frame to observe a 6-hour TPD through the lens of a lower time frame would be the 1-hour time frame. So going down to the 1-hour time frame, we can see this would be candle 2 right here. So it'd be this candle right here through the lens of the lower time frame. So as we can see, the S&P runs above the high of candle 2. The NASDAQ runs above the high of candle 2, while the Dow fails to run above the high of candle 2. Now, how could we have gotten that information? Well, if we look back at the chart, we can see, looking at the NASDAQ made an up close candle for candle 2, but more specifically, the open of candle 3 was higher than the close of candle 2, meaning this was going to be the one that's more resistive for downside and easier for upside. So that's why as soon as the next day opened up, which would be right here, because remember, the 6-hour TPD formed in the PM session. It was the last 6-hour candle of the day. So candle 3 would be the new 6-hour candle of the new day. The new day trades higher, trading above this high, while the S&P created a lower open compared to the close of candle 1, while the Dow made a lower open compared to the close of candle 1. Now, how could you have inferred that the S&P was the one in the middle and the Dow was the absolute strongest for downside, weakest for upside? Well, let's take the opening price of candle 1 compared to the closing price of candle 3. What? There's a cracking correlation here. We can see that the Dow, candle 3 closed below the open of candle 1, while on the S&P, we can ignore the NASDAQ because the NASDAQ has the up close candle and it's the one that formed the higher open. So we can ignore the NASDAQ. Now we're just differentiating whether the S&P is the one in the middle or the Dow is the one in the middle. If we look at the open of candle 1 and the close of candle 3, you're not going to be able to see this, but you'll see what I'm talking about. But we can see that the S&P is the one in the middle. So using that information, and this told the tale for why it barely wicked above this high, but you weren't going to see it until the close of candle 3. But we're going to dig into something a little bit deeper. So the Dow is going to be the one that's strongest for downside, weakest for upside. And we have this cracking correlation formed right here. So candle 3, envision it right here. It'd be this candle. You can see it trades above this high right here being candle 2. Candle 3 trades above this high. Candle 3 creates a failure swing. So this is a short-term weekly cycle sequential SMT. Following in tune with TPD. Whenever you have TPDs that follow in line with quarters, and it is sequential SMT, it is high probability. But there's a caveat to it. Whenever you have a weekly cycle SMT form specifically in Asia session, which would be Q1, the New York morning session has a tendency to create an unprompted reversal, meaning it can just, boom, come way out of left field and completely wipe out this weekly SMT. Whenever you have weekly cycle sequential SMTs that form in Asia session. So now you're probably wondering, okay, well, it didn't run below this low. There was no SMT there. So I get that there was, there can be an unprompted reversal. But what was the thing that really, really kicked price off? So keep in mind, draw it out like this. So where that weekly cycle sequential SMT was the smart money reversal. So the reversal calls on candle 3, while candle 2, this portion of price action right here, was the reaccumulation, while this price action right here, what would this be? This consolidation. Exactly. It would be the original consolidation. So we have the TPD, we have the first phase, and then we have the original consolidation. Price breaks lower, but it doesn't trade at the low of the original consolidation. So you're probably thinking, well, this is incomplete. And Q1 people, your minds are about to explode, but this was a hidden SMT. A hidden SMT is SMT between the bodies. But more specifically, what have I stated? What adds probability to an original consolidation? Because I said in the past, hidden SMT is low probability. But what adds probability to an original consolidation? Unsymmetrical price action within the original consolidation. So let's look a little bit closer. What do we see right here? What is this? They're unsymmetrical. So why was, and remember what we talked about earlier, how could you have figured out that the S&P, if you ignore the Dow because we don't trade the Dow, How could you have figured out that the S&P is likely to run this low? Because this is the lowest close, while the NASDAQ creates a failure swing. Exactly. It's the asset that's in the middle. So whenever this formed right here in the morning session, we already know that the morning session can cause unprompted reversals whenever you have a weekly cycle sequential SMT form in Asia session. So this was the kicker. This was the thing that kind of came out of left field and launched price higher. It made it trend higher for the rest of the day. And keep in mind, this was the original consolidation of the market maker model. Specifically follows in tune with the weekly cycle SMT. That's something for you to look into. But anyways, so what caused this downside movement right here? Because we were expecting lower prices, and I'm not going to give myself too much credit because I had an invalidation level right here, and some will say it's a market maker attack, some will say da-da-da. Sometimes things like that are going to happen. But the real cause of this move right here was manual intervention. So manual intervention is something that will happen from time to time in the markets. And you're not really going to know when it's going to be there until it's there. Manual intervention is outside forces that impact the market that you don't really have too much control over. But something about manual intervention is these are the things that it will do. It will, 1, push price in an anticipated direction. Or 2, delay the progression of an anticipated direction. So these are the things that manual intervention will do. So you shouldn't be scared of manual intervention whenever it comes. If anything, manual intervention is like a very, very high impact news driver. If we could take manual intervention and place it on the tiers of news, it would be above CPI, non-farm payroll, and FOMC, which is why we saw this. And in specific, the thing that took place was President Trump. He had brought out information on tariffs, and as we know, that has a high impact in the market, which is what caused this. But irregardless of what the reasoning is just the smokescreen. Manual intervention will either 1, push price in anticipated direction, or 2, delay the progression of anticipated direction. So what do I mean whenever I say delay the progression of anticipated direction? Who remembers this? So this is an example of delayed progression caused by manual intervention. This happened in the past. And yes, for the Q2 people, this was called out beforehand. This is not hindsight. But we were already expecting higher prices within the group. We were expecting higher prices. And then out of nowhere, boom. Information came out that affected tech stocks primarily, as well as the S&P, which is what was the catalyst for this huge drop. But what formed in specific due to that drop? A sequential SMT. And then there was also a TPD in there as well with the Dow, and there was a two-stage reversal, but that's besides the point. This is an example of delayed progression caused by manual intervention. If it wouldn't have, or since it didn't expand higher and cause price to trade higher, what did it do? Form a cracking correlation and gave price a reason to trade in the anticipated direction. So that is a lesson on manual intervention. So as we can see in today, there was no real bearing, no real reason. Price just boom, traded lower. Now, as far as what we can see next, since we've had majority of the volatility play out for this week, I don't expect non-farm payroll to deliver too crazy. But keep in mind, we still do have these lows on the S&P and these lows on the NASDAQ that we wanted to see both of these assets work towards. And then we have this low on the Dow that we wanted to see get hit. So our analysis has been moving in the direction we've been anticipating price moving. But I do not recommend trading non-farm payroll since we've had this extreme range. Non-farm payroll is either going to slightly return into the range or just completely go down there and wipe out those lows. I wouldn't want to play a guessing game. I wouldn't want to try to trade ahead of non-farm payroll. It's one of those things where it's either going to deliver very well or it will just be a lackluster two-stage news event that will just remain consolidative. So especially if you're a little bit newer, don't play guessing games. Don't try to trade ahead of non-farm payroll because trust me, you will likely regret it. But as far as I'm concerned, these lows still are the draw on liquidity, irregardless of how Friday trades. But once Friday closes, that can give us clarity as to how next week will play out. So is everybody on the same page? Now we can do some Q&A. That's a lot of information at a time. What is the order of operation? How would you come into Wednesday or even Tuesday to formulate an idea? Or is it for us to figure out? What days do we expect high of the week to form? And yes, today was a very advanced day. So Q2 people, I'm sorry if this was a little bit more advanced or a little bit more difficult to understand. As time goes on, it'll make more and more sense. So while you're in that learning process, just rewatch the videos, keep backtesting. Eventually you will get a really good understanding. Could you go over price limit rules on prop firms? I don't know. I don't trade on prop firms anymore. Is an unprompted reversal of the weekly cycle SMT in Q1 fractal? Is there a daily cycle SMT occurring in the 90-minute? Yes, everything is fractal. Everything I'm teaching you works on every single time frame. But I'm teaching you in a sequence or in a manner that follows in tune perfectly with quarterly theory, which is why it works so well. Shout out Day. But yes, for actually trading this, the way to trade this was purely time. because we expected Wednesday to be the high of the week. If we ignored the candles, let's say the candles didn't even exist, we already know that the high of the week should form either Monday, Tuesday, or Wednesday, somewhere around here, and the low of the week should be here. So with that being in mind, we can forecast and say, okay, since we know the high of the week is going to be here, we can enter somewhere within here just based off time, and then expect it to drop lower and then close either portion of the range or at the low of the week. So time comes before price. We just use these candlesticks to validate time, which there wasn't that big of a validation this week because this week was super low probability. But that is the idea for a weekly habit. Just using strictly time for predicting the weekly range. Was there a reversion level today at the 7 a.m. TPD candle? How would you enter? The reason why I'm not reviewing today's price action is because of the message I sent out in the WAP. Thursday, especially the Thursday before Non-Farm Payroll Friday, that specific Thursday tends to be low probability, and precision elements get skewed off. So that's why on days I don't really tell you to do anything, or days I say, hey, be careful, don't really trade this day. That's why I don't review them, because those are the days you shouldn't be putting too much focus on. You want to focus on getting good at the good days. But once we answer a couple more questions, we can go look in there. If we are bearish on our narrative time frame 4 hour and we have a lower time frame sequential SMT, daily cycle sequential SMT below the previous day's low, can we take that trade into a premium fair value gap, external to internal? I think you alluded to this during a video this week and want to know if I'm on the right track. Yes, you are on the right track, and you can use that daily fair value gap or that higher time frame fair value gap as a draw on liquidity, going from external to internal range liquidity, and then vice versa. We're going from internal to external range. In your core content, you said that the 1 hour SMT failed because there was no second stage on the lower time frame. Wouldn't the 9 a.m. 1 hour TPD confirm this as a true reversal? Also, can a lower time frame TPD confirm a higher time frame SMT, or only a lower time frame SMT? So I know exactly what you're talking about. I had somebody bring this to my attention as well. And I just removed the Dow. But if we look at actually where that TPD took place, so we have the SMT right here. So this was the candle right here. This was the candle that ran above this high. But the TPD didn't form until right here. Whenever you have an SMT on any cycle, if it's a TPD or PSP that's confirming that SMT, you want it to be either the immediate candle or the candle after. Those two candles, so why am I choosing these candles in specific, or these two candles? This is the candle that ran out this high, creating the SMT. For a high probability PSP or TPD to confirm an SMT, using a TPD to confirm an SMT, you either want that immediate candle that caused the SMT to be a PSP or TPD, or the candle after. And sometimes, only sometimes, the candle after that. But if we create an SMT and then drop, is this PSP or TPD in premium? No. So is this high probability? No. So that's why this failed. That's why I don't count this as a second stage. Now, if the TPD or PSP would have been, right here, I would have been like, okay, that is the second stage. That's perfect. Boom. Everything's in alignment. But since the TPD was delayed, and especially formed a discount whenever it was a premium sequential SMT, that is why it failed. And that's why I don't count this necessarily as a second stage Kraken correlation. Does that make sense? Do you think Trump's tariff news, even manual intervention, could have trumped the weekly halving theory? In that it's possible we have sent price higher instead, or no, it was either going to dump the market or delay the dump, eventually getting lower. Yes, so like I said in that video, I said if it would have traded higher, or if the market would have traded like way higher, now it did, like I said, it barely tagged the reversion level, and then, or it went through it right at the manual intervention, and then traded lower. But besides that, it's besides the point. I said if we were to trade a lot higher Wednesday and just completely, run higher and higher and higher, then this was going to stay the low of the week. And Thursday or Friday would be the high of the week. And then next week could have offered the movement or the progression that we wanted to see, while this would have been the delayed progression. Is non-farm payroll the monthly manipulation? Sometimes, but not always. If anything, it'd be CPI. But looking at what this one wanted to say with the 7 a.m. So let me read out this question one more time. If I can find it. Was there a reversion level today at the 7 a.m. TPD candle, and how would you have entered? So we were already expecting lower prices, and there was no real catalyst for price to turn. So this higher time frame, or this 1 hour TPD, and also if we take into account, we can see extremely bad price action. But taking this into account, oops, skewed it on the lower time frame. So there was no real bearings on price backing this up. So this is already low probability because there's not narrative or direct narrative on this TPD. And if we look at it through the lens of the 15-minute time frame, going from a 1 hour TPD to the 15-minute time frame, we can see that the price action within there is extremely lackluster and choppy. Whenever you have TPDs, whenever you're looking at candle 2 through the lens of the lower time frame, and they're extremely choppy and consolidative, telltale sign that is low probability. Another thing is if we take the high as well as the low of the candle, we can see that 8 o'clock, being candle 3, took both the high and low of candle 2. So that immediately invalidates everything. Candle 3 should not take both the high and low of candle 2. Candle 3 is meant to act as distribution, and the weakest asset is typically runs either the high or low depending on the narrative, while the stronger assets will create an SMT or a failure swing. So this is, in my opinion, low probability. This isn't something I would have looked to take anything off of. And this is the reason why. We took both the high and the low, as well as it being very lackluster and consolidative. No real change in the state of delivery within the candle. Does the first candle that opens a new quarter belong to that quarter? Yes. It does, yes. But anyways, hopefully you all found this one insightful. I will catch you all tomorrow in the pre-recorded lecture. So with that being said, if you found this one confusing, or if you're a little confused, don't worry, that's okay. You just need a little bit more time. You can rewatch the video however many times you need to. With that being said, I'll speak with you all tomorrow. Good luck and good trading.